agree entirely on everything you said. I think gold is ultimately how they get out of this. There are provisions in the Federal Reserve Bank operating manual by which the Treasury, United States Treasury Secretary, can instruct the Fed to write up the gold, the US's gold, and the accounting treatment of that is a deposit, free and clear, no debt attached to it, into the US Treasury general account. So at 261 million ounces or 8,000 tons, every $4,000 per ounce the Treasury were to instruct the Fed to write up the gold would deposit roughly $1 trillion, 4,000 times 261 million ounces, into the TGA. So like, if you said, Luke, your Treasury Secretary, how can you get out of this? We need to get our debt to GDP down right away. How do we get out of this debt spiral? I call up the Fed. Powell, it's over. You've lost the long end no matter what you do. Write up the gold to, I don't know, it's a $24 trillion Treasury market. Prices are probably down, Mark, face value 30% on average over the last 2-3 years. So the real market value of the US Treasury market, I don't know, 12 trillion, 15 trillion for round math. I'm going to write up the gold by 10 trillion, right? So it's $40,000 per, just actually do 5 trillion, just take a third of the debt out. I'm going to write up the gold by 5 trillion. If I write up the gold by 5 trillion, every trillion is $4,000. So it's $20,000. And I get 5 trillion deposited into the TGA, free and clear. I go out into the market and I buy back a third of the US debt outstanding. Now it's a $10 trillion market value market against GDP of 27 trillion, give or take. Voila. We've gone from 120 to 40% in one stroke. Thank you for your donation, Treasury holders. Now, inflation rips, the dollar probably sells off quite a bit, but that's all in the cake. That's going to happen no matter what.
Would returning to a gold standard help the U.S. economy? Can you talk a little about your thoughts on that?
Well, I would say I don't see it so much as returning, but more of a back to the future.
Okay.
I think that what a gold standard stands for is monetary discipline for its own sake. That is, if money is supposed to be a unit of account and a reliable measure and a dependable store of value, it really shouldn't be subject to who's the chairman of the Federal Reserve. And I think that money needs to be stable and provide the foundation for productive economic growth. And when money is just a variable that financial markets toss around, or it's part of a derivatives formula, or it's part of someone speculating on currencies, it's not serving the private sector in the sense of providing that reliable unit of account so you can make plans. And under a gold standard, you did have that stability, and I think that's what's missing. And so I like the idea of a gold standard. I mean, it could be used in a very cryptocurrency way. The point is, do you have a unified money system so that when you talk about the international marketplace, everyone is playing on a level monetary playing field? And it's very important to have a rules-based approach. And that's why I'm advocating that we need to look at the virtues of a gold standard and try to come up with something much closer to matching those. And then I think we would have more solid economic growth.
The BRICS group is set to introduce a new currency backed by gold, in contrast to the credit-backed US dollar, with countries lining up to join the growing initiative.
The BRICS countries are planning to introduce a new trading currency which will be backed by gold. More and more countries recently expressed desire to join BRICS.
The decision comes a month ahead of scheduled Alliance Summit in Johannesburg, South Africa. 41 countries have since shown their interest in BRICS membership and its new currency implementation. Russia's foreign ministry has stated that if African states show enthusiasm, the group's expansion may also be on a Russia-Africa summit's agenda in the end of July. As of now, the BRICS group remains comprised of Brazil, Russia, India, China and South Africa. Former Statistician General of South Africa, Pali Lehola, says the gold-backed currency will facilitate the advancement of developing countries.
avoiding using the gold standard. We have gone for almost 45 years now, since 1980 when this was dropped. And we have seen the consequences, particularly of this to the developing countries, when the dollar was adopted as a standard and gold not as such. Yet against that, there's been accumulation of gold in the developing world. South Africa had a much stronger currency when the gold standard was still in force. By going the gold standard by many countries, that many African countries, of course, have, this will be of great benefit to strengthening the currency, the single currency that is backed by gold. It will facilitate development because, after all, currency is the quantity of material things that societies have. If you use another currency based on material wealth or material things you don't have, it means that you are at the mercy of that country, and and they will charge commissions and the like.
Hey, Lynette, you have all this money here. What's this about?
Well, first of all this paper is government debt-based money, which means it loses value over time, versus real sound money, physical gold and silver that's been money for over 6,000 years. But what I think is really interesting is this is the Venezuelan bolivar, a 20 bolivar note, which was devalued through hyperinflation, and you can't buy anything, it's demonetized. But this is a 500 million bolivar note, and guess what? You still can't buy anything with it because of hyperinflation. But physical gold and silver, anywhere in the world, same level of purchasing power. That's the point of sound money. It holds your purchasing power over time. This stuff, by design, inflates to zero.
You recommend that most portfolios should contain some gold. Why?
Yeah, of course.
Why? A lot of people think it's not of course. In fact, it doesn't make sense.
Well, first of all, to structure a portfolio, the best way to structure a portfolio is to have the right kind of balance in your portfolio. So, and some amount of gold. Gold serves a purpose. It is, first of all, a diversifier against other assets. You know, we have this risk-on, risk-off thing. We also have a monetary system. The Bretton Woods monetary system began after World War II, and it had the dollar as the world's reserve currency. There's a risk there. There's a lot of dollar-denominated debt and so on. If somebody felt that they didn't want to hold that and so on, you could have exposures to that. So it's a diversifying asset that is sensible, and you know, that's the main reason to have gold in the portfolio, 5 to 10%.
We think that this is a major driver of the sanctions resistance of gold, is a major driver of the increased rate of purchases of gold by central banks. I doubt that emerging market central banks would look to increase their holdings to the sort of 30, 40, 50% levels that some of the Western central banks have. But I think we could easily see, on average, up to double digits, maybe 15% as a level that could be conceived and justified. And if that's the case, then we could be seeing gold purchased by central banks for years, maybe even decades to come. You could foresee a situation where a BRICS plus trading currency were to be backed by gold. You'd have to work out where to store that gold, and it wouldn't be London, obviously, for sanctions reasons. But where would you put it that you would trust it's there and that you would trust you'd be able to get your hands on it? And I've given that quite a lot of thought, and there aren't too many alternatives that spring to mind.
I think that when I hear Snickers, when we talk about convertible bonds into gold for various countries, the fact that there's Snickers at all really depresses me. Nobody seems open-minded to protect what's in our wallets. Can you finish out telling me why that potential should be considered?
Well, Rick, what I would want to bring to this position is the willingness to examine the fundamental question that I think is at the heart of what you just sketched out. Money is meant to serve as a reliable measure. It's really the key to free market capitalism. You have to send signals about prices by having clarity. And money's supposed to be that unit of account that provides it. It's supposed to be a dependable store of value. It's not supposed to be just another government policy instrument to try to engineer outcomes. And what we've seen is central banks trying too hard to do just that. And they've engineered us right into a negative rate scenario, which completely undermines the idea of having faith in the future, which is the very virtue of capitalism, that people have a positive outlook. They think it's worth it to sacrifice today, to save instead of consuming, to invest that financial seed corn in the possibility of a greater harvest. And it's that kind of financial intermediation that actually creates a higher standard of living, that brings opportunity and prosperity. That's what we want to foster, not a continuing speculative game that's just played in a 5.1 trillion daily turnover currency market.
I'm a broken record. Buy gold, buy silver. Not ETFs, buy gold, buy silver, the real stuff.
And I'm going to add, you like Bitcoin too, though.
I like Bitcoin because, well, we have an enemy in common. It's called the federal government, the Treasury, the Fed, and Wall Street. I don't trust them. If you trust them, save dollars and get yourself a nice bond. I don't trust those guys.
There's ways you can. There are extreme measures you can take. I've talked about this before. If you go to the Financial Accounting Manual for Federal Reserve Banks, you can Google that. It's online. It's a public document, Section 2.10. Treasury Secretary can instruct the Fed to revalue the gold on the U.S. government's balance sheet. 261 million ounces every $4,000 is about $1 trillion mechanically dropped into the Treasury General account, free and clear, no debt offsetting it. $20,000 an ounce is $5 trillion. Yellen could take that $5 trillion, wade into the Treasury bond market, buy back $5 trillion in bonds overnight, increase basically the money supply by $5 trillion overnight. Voila, U.S. debt to GDP.
Wait, you just revalue the gold? Because the U.S. has a ton of gold, right? I mean, it's like the most gold reserves of any country in the world. Yep. It's like, what do you mean revalue it? You could just like name your price? I mean, don't they have to go for a market value?
What's the market? Men with haircuts like mine and guns tell you what the price is.
Wow.
It's in the Federal Reserve Operating Manual.
So there's levels.
I didn't know the Fed has an operating manual.
Right.
There's a Financial Accounting Standards Manual. Yeah. You can look it up, Google it. It's right there. And so, so what happens is Yellen gets $5 trillion deposited into the TGA, and she buys back $5 trillion in bonds. Boom, overnight. Now the U.S. debt to GDP is, between taking out $5 trillion in bonds and the resulting nominal GDP growth, which is going to friggin' explode because you just increased the monetary base by $5 trillion. So inflation's going to go nuts. Like, that's in the cake. That's going to happen no matter what, because we've done a bunch of stupid stuff with borrowed money for 30, 40, 50, 60, 70 years. So now you end up with debt to GDP 50, 60%. Now you can take rates to 8, take rates to 10. Nasty recession, who cares? You're going to put some private sector people out of business, but who cares? You're not going to threaten the solvency of the U.S. government. They'll be able to pay 10% rates. And I'll be happy to, if you buy back all that debt, and I'll be happy to sell my gold at $20,000 an ounce and buy 10-year treasuries at 10%.
As a gold buyer, Clive, what do you tell people, who haven't had exposure to gold or maybe haven't added to their exposure to gold in a while, who look at the price and say, well, I don't want to get in now. It looks too high.
It certainly doesn't look too high to me. I think given the expansion of the central bank's balance sheet over the last decade and the huge increase in government debt, gold has not kept pace with that. And there's a lot of room for the gold price to go higher. And it will go higher if we have a currency crisis and there's a loss of confidence in the currency. Why would we have a loss of confidence in the currency? Well, it could simply be that government spending is out of control. They can't rein it in. They're having difficulty borrowing the money except at higher and higher rates. Then there's a spiral down in the government bond market, and people say, is my money safe sitting in the bank? Because the bank owns these government securities which are falling in price, and they start to try and put it in something safer. And gold is one of those places where it might end up.
Keith Neumeyer will tell you it's coming out of the ground at 7-1 after 5,000 years of it coming out of the ground at 16-1. Because it's held in nature in a form called epithermal, like your skin is epidermis, epithermal, right at the surface. Big deposits were gone long time ago. So it's needed in military, in green, in digital, in electronics, and it's experienced a monetary renaissance. And yet we're supposed to believe that it's coming out of the ground at 7-1, but it should be valued at 80-1. So God's ratio says 7-1. Man's price in the West says 80-1. And I would simply say this. There was a statement made by the head of the Shanghai Gold Exchange in 2014. And I'll throw silver into this equation too. He said, when China is allowed to speak at the table, the real value and the real price of gold will be revealed. Well, the same thing will be true about silver. And Zoltan Pozsar will go down as one of the smartest people ever, who told us all we are now entering Bretton Woods 3, a system about who's got the commodities. And so these countries that are gobbling everything up, well, they're using the suppression that we've been fostering forever against us, where 8 stupid banks can hold the price down of a commodity that is massively acquired and needed, distorting its real value forever, as dumb as a mud wall. Why? Well, there's your why. Because it's needed to fight wars and build high-tech weaponry. So yeah, the most undervalued, underappreciated, best value of anything I've ever seen in 35 years of finance.